Welcome to episode 12 of the Groundfloor Market Trends podcast. We're excited to have Damon Riehl, founder and CEO of Investment Property Loan Exchange, otherwise known as IPLE. He has over 40 years of lending experience. I oftentimes am the most experienced person in the room. Not today. He's got me almost by 2x in experience. He has a broad array of experience in asset classes, both commercial and residential, mortgage, small business, and construction lending. He's held top leadership positions as head of commercial lending for Ocwen, head of unsecured lending for Citibank, global mortgage leader for GE Capital, head of construction products at Fannie, and a former member of the Harvard Joint Centers for Housing Studies. Damon has built 6 de novo lending platforms and used that knowledge to build and grow loanbids.com by Investment Property Loan Exchange. Damon, welcome to the podcast.
I'm really happy to be here and happy to see all the great things happening at Groundfloor.
Absolutely. And so, when I think of IPLE and loan bids and your career and what you've built and the sort of volume that you do, you choose to remain an intermediary or a broker in our parlance. And so why is it that you have specifically chosen to remain an intermediary and not sort of, evolved or chosen to become a lender, which you could do, with your experience and your volume pretty easily?
That's a great question. So what I'll say is that 40 years of experience has told me and shown me what I don't want to do. I've been through a number of downturns, and in those downturns, I was with some of the top banks and lending institutions in the world. And what I saw was a situation where there were parts of the business that really had some problems. So for instance, you're with top lenders who are doing things very well. And during the downturn, you saw, mortgage insurance companies or Fannie Mae and Freddie Mac trying to push loans back on these lenders who were doing things the right way and maybe had technical errors here and there. So I said, you know what? I don't really want repurchase risk in this world. I also was in a situation where, as a builder of businesses, that you see there's certain parts of the process that are very expensive. Those things like hiring underwriters, hiring capital markets people, hiring compliance folks and QC folks, just to make sure that the production that you create turns out to be the quality that you want it to be to deliver to your investor partners. So that's a very expensive part of the business that really doesn't generate income. It's a cost. So as I got into this business, I said, you know what? I don't want repurchase risk. I don't want all this extra overhead early on in this business life. And you know what? I don't want interest rate risk either. If I create a loan today and interest rates go up tomorrow before I've had a chance to deliver it to the investor partner, I might wind up having to take less than 100 cents on the dollar for that particular loan. So it's like, I don't want that. So what we do is we are a matchmaker. So we have all of the top private lenders on our platform, Investment Property Loan Exchange. We're trying to, get the loan bids name out because that's the website platform, and that's where people seem to know us better. So, what we're trying to do is really grow as a wholesale commercial mortgage broker. And as being a part of that, what we're doing is we're working with investors directly, real estate investors who are looking to acquire properties, who are looking to refinance properties. And, what they do is they rely on us to be a trusted advisor to them. So the way we're positioned, we're on their side of the table, working with dozens of private lenders and finding the best option on their behalf. And we like that position, that client advocate, that person helps them navigate the private lending industry. So again, we work with thousands of investors, and that help that we provide them seems to be very well received. Plus,
Yeah.
because, like you said, we do so much volume, it's a situation where we get very good pricing from our wholesale lender partners. And we're able to include our fees into the process and still be highly competitive with lenders who are working directly with borrowers.
Yeah, it's amazing. So we can certainly relate to building a platform and building it organically. And you've narrowed your focus to the origination side. We marry investors with specific loans, mostly RTL. We're just starting a DSCR, although that doesn't go on the platform. And over time, you learn a thing or two about the business development and unique products. From a ground floor perspective, we welcome the deals that you guys bring to us. I'm curious, what is it? What features do you encourage your salespeople to sell about ground floor loans to attract more deals?
So with a fix and flipper construction, there's really two things that our clients are looking for. And the first one is they want the least amount of their money in the deal. So they like to see higher leverages. They also like to see the lowest fees possible. They tend to be less rate sensitive because they know it's a short-term loan, and anything literally under around 13%, they're usually fine with, as long as you're getting them that leverage that they're looking for, that the least amount of their money in the in the deal, and a reasonable amount of fees. So the one thing that Ground Floor has really brought to us, is that plus some other features. So, many of you are listening here understand the Ground Floor program and how the innovations that Ground Floor brings can help, can help investors. And one of those is the fact that they defer payments. So with the deferred payment option, my clients, they're not earning money that 6, 9, or 12 months it takes them to do the rehab on this particular project or the new construction. So literally, they're having to come out of pocket every month out of their reserves with money to make that interest payment. Well, Ground Floor is one of the only lenders who will allow that payment to be deferred until the exit, and that's a huge benefit to our clients who really are trying to really conserve most of their cash. The other really cool feature is the deferment of the origination points. So as you're looking for the least amount of your money in the deal, part of that entails or includes points and fees that have to be paid. So with Ground Floor's program, the ability to defer those origination fees until the exit gives our real estate investors the opportunity to essentially keep that money in their pocket and pay that at the exit after they've improved the value of that particular property. And that is really cool. So those are the two main things. Obviously leverage and fees are critical. So you've got kind of all four of those going for you.
Yeah. And it's that product. You've been with us, a good long time. I remember talking to you around COVID, right? So,
Right.
and even, prior to that. And, one of the things, that has been not a challenge, but something that we, stuck by was that deferred payment. And, it was oftentimes from the capital market side, looked at as not, something that you could sell on the capital market side, meaning we would hold it for our platform, until recently. And as you know, we just did our first securitization with deferred payments. And that was, landmark for 75 million. And that's a first step towards achieving that mission of becoming inevitable in this type of lending. And we feel like it's a game changer. And we're very thankful for you and others that have continuously brought us deal. And you're part of that too. And you sharing that success that we had. And we look to do more of those, right? And why I bring that up also is you and I have been sort of around this business for a long time. I did my first hard money loan in 2004. Right. And it was a very sort of fractionalized group of lenders, right? And then you sort of had Lending Home, which is now Kiavi, come across the scene in like 2013. And it brought, they were the first to sort of, make this a national, product where all 50 states, one lender. And now you have others like Rock, you have Groundfloor, RCN, all these lenders competing for the space. And this space has matured, right? And this securitization is just a further reflection of how far this space has come. And it's been very hard work, right? And you could say loan bids and IPLE and Groundfloor have been part of that, right? And connecting investors with capital, right? And making this space what it is. And so I don't know if you have any thoughts on that, but I often reflect on the manner in which, in all positive ways, this space has really become an asset class.
I agree with you. And I think that in the past, when you use the term hard money loan, the connotations kind of speak for themselves. You think of something happening in the back alley, and now it's changed. Now it's really private lending, private
Right.
capital, and it's institutionalized. You can see you're getting securitizations done. So it is literally a highly legitimate class of assets that investors want.
Yeah, the yields are great. The performance is very strong. And, we're talking about RTL, which is the fix and flip. I know that you have a very strong DSCR program as well. So why don't you, which is something that we recently launched. So why don't you talk to us about your DSCR program, how it fits in the overall scope of your business and what you expect of it in 25?
So, so our DSCR business is actually, a bigger part of our business than our short-term lending. We do about 2/3 of the loans each year in the DSCR program. It's been a great product. We've got great partners in our lenders who give us the platform to be able to do the DSCR really well. Um, you know, their capital sources for those particular lenders currently tend to be insurance companies.
Mm-hmm.
So the DSCR product is a lot more consistent in the underwriting requirements because there are really two or three main buyers at the capital markets level. So many of the lenders that we work with are simply taking that particular product with their price and then relaying that price onto us and giving us the ability to then compete in the marketplace. The SCR is great for us because we get a lot of repeat clients on that. So for instance, up until recently, and for the last year and a half or so, when rates were rising, we saw a shift toward more short-term loans
Mm-hmm.
and smaller loans on the
Mm-hmm.
DSCR side, because the DSCR with the higher rates, it made it a little bit harder to pencil in, certain higher value properties to cash flow. So we saw that little dip down in rates in midsummer,
Late
and
summer. Yeah.
yeah, what we saw were, instead of people refinancing because they were coming out of a flip, we started to see people that had acquired properties during the COVID period or slightly after that, and now looking to extract cash to buy more properties. So that's kind of slowed down a little bit here in the December timeframe. Those people doing it for that, but I will tell you, our business continues to grow. Month after month, our pipeline is bigger than it was the month before. And this year, we're fortunate that we grew 50% in
Wow.
2024. Yeah.
Great
So,
job. Yeah.
yeah.
Amazing.
So we're excited about that. We have a great team, a great sales leader, a great ops leader. Again, we're doing it kind of the hard way.
So are we.
In the wholesale business, you put a few underwriters together and closers, and you put out an aggressive rate sheet, and you got $100 million worth of volume.
Yeah.
We've been doing this now we're coming up on 8 years. We've grown slowly and consistently. And we'll do. We did just a little over 200 million in loans this particular year, but it was 1,200 loans.
Right.
So again,
Do you
it
have a
is.
do you have a geographic focus? I mean, I I'm I know because I've oversee underwriting here, so I kind of know this. But why don't you go through, like, especially on the fix and flip side? I know it's a lesser portion of your overall book, but or your origination activity. But where do you see loans mostly in from your side?
So I would say in the tier two cities is where we're
Hmm.
getting a lot of call. I mean, we're still getting, this morning I think we got 30 or 35 leads in, so we're seeing it from all over. I know the Birmingham area is still hot. The Atlanta area is still doing well. I wouldn't call Atlanta a tier two, but
Right.
we're getting a lot of things out of Tennessee. Uh, we're doing a ton in uh, the Philadelphia area of Pennsylvania. We're doing a lot in Indiana, Ohio. So we're kind of a east of the Mississippi. I don't know why we have a lot of states west of the Mississippi, but it just seems like the business east of the Mississippi in those tier two cities is where not only fix and flip, but a lot of our DSCR is coming from as well.
I think it makes perfect sense. I think
Mhm.
with the cost of housing, especially in tier one markets, I think it's natural to see the evolution go through smaller cities with maybe easier price, more affordable price points that have more upside potential, which is what the fix and flippers are trying to generate. And I think that's why you see, like, the northeastern markets, some of this, even the tier two northeastern markets are starting to take off. So Philadelphia, not a tier two market, but lots of renovations to do in Philadelphia for sure. And so it's, that mirrors what we see. I was thinking through, back to DSCR, thinking through, the primary reason why we like DSCR. It's really about our platform, right? Our platform is made up of mom and pop investors, and they're one of the benefits to the platform for those investors is liquidity, right? So the stronger we make exit liquidity, right, the more expert we become on DSCR loans, the more we're able to get loans into the position for resale or for a DSCR loan, helps our platform because it's probably now more than 50% of our exit liquidity. So it's hugely important for our platform and its ecosystem to make sure that we're executing on those loans properly and understand that market. And so, we look to you in 25 for deals and for ways to exit our loans as well. So we definitely look forward to working with you guys in 25, on a level that maybe we didn't see in 24 for sure.
I would welcome that and appreciate that.
Absolutely. And so let's move on to 25 and what we expect. Relative to, we talked about geo. What is your take on interest rates and where they might move and how that might shape or shift our market?
That's an interesting question. I think it's different for DSCR than it is for fix and flip. I would say fix and flip is less rate sensitive. Uh, you know, if we get a move down 0.5% or 1%, great. Our clients are better off. However, again, as I mentioned, that's not the most important factor for them. It's the leverage and the fees, and then some of your features. For DSCR, it's different. Um, I, we have sales meeting every week, and I think what we've come to learn with DSCR is that we can win in any environment, a rising environment, a falling environment, but we like stability. We like the rates to stay in a relative range for a period of time. If they stay where they are right now, we're fine. We're going to do a lot of loans because we know that we've got the best lenders on our platform, and the clients that we're working with aren't being chased by other people that, I quoted them a rate yesterday. The rate today is a little bit lower, so I might lose the deal. So again, stability for us means we know that we can win consistently. If rates go down, great. More deals will make sense. More deals will pencil, and
Mm-hmm.
we'll do more loans. And those clients who have a pool of properties that are waiting for the right time to execute on a cash out refinance, that will be, there's a bunch of those folks out there just waiting to refinance those 5, 10, 20 properties that they've accumulated, but they're sitting there scratching their head and going, you know what? Not at 7%. I need
Right.
something in the mid low sixes, which I think we'll probably get there. And we were there for a heartbeat, in the
Right.
fall. But I think there are people that have a mental, number in their head, and they say, you know what, when rates get here, if I can find somebody to do it at this number, I'm going to pop a lot of refinances and raise cash. So
Do they raise cash on a short-term basis, or do they do that through longer-term loans? Is it the bridge loan, the 12 to 24-month bridge loan that they're looking for, or are they yeah,
no,
okay. It's the longer term.
yeah, they're getting 30-year fixed DSCR loans. If they think they're going to need to exit some of those properties, they might take a shorter prepayment penalty period. But we're not seeing many of those. We just are in the process of closing a big deal, about 129 properties for a client out of South Texas, and that particular loan is a 30-year fixed, and he wanted the lowest possible rate, so he took 5% prepayment penalty for 5 years. So he took that, the highest level of prepayment penalty because he knows he's not going to sell it. But
And that's
so
gonna
so he
that's
got a
gonna
little bit
offer
better rate.
that's
Yeah.
gonna offer the best rate. Got it. It makes sense. I think as far as rates go, I'm like, sure, I think about rates a lot. What I think about more of relative to the affordability question from, home buyers is insurance. Um, Markedly increased over the past couple years. It's been on a, upward trajectory, as you know. Um, and for me, it helps level set specific geos that we want to focus on, right? We definitely see rising premiums in Florida and Georgia, some of our preferred markets really. So, we look to diversify our geos in 25. I'd say that's one of my main priorities, right?
Makes sense.
I don't know how about you feel about that, but I mean that's just seems to me clear, right? I don't know if you have thoughts on that, but how do you see
Yeah,
insurance?
for us in insurance, again, it's really more on the long-term loans that it's really impacting cash flows. So I mentioned that one portfolio that we're working on closing. That particular 129 properties got broken into 11 different loans. So we have a small group of those loans that because of insurance and the cost of insurance are having a hard time penciling at the max LTV. So we're in the process right now working through with our lender partner, you know, can they take it a little bit below the target of 1.15 DSCR and just
Mhm.
close the deals at max leverage? Do we need to reduce the loan amount a little bit? Do we need to increase the rate a little bit for them to take something slightly below 115? So again, insurance is definitely impacting long term, and really it's in every market. I
Yeah.
think everybody's insurance has gone up. I'm here in Southwest Missouri, and our insurance goes up. So, I
Yeah.
can imagine, California with the fires and Florida with the storms that
Mhm.
and it's a big challenge.
Yeah, it absolutely is, and I think it's felt even more. It's felt even more acutely where affordability is really challenged. Those states that had really significant appreciation, or geos. You can talk in geos and not states, but there was aggregate appreciation. Post COVID, and some of those top tier markets that we've discussed. And I think from a lending standpoint and from an origination standpoint, I just would love to see a spread out more, and diversify across a lot of different markets. So I'm giving you a hint. I want to see loans across a lot of different geos this year. And I know that you've been a great partner, and I know that we can talk more about that, down the line, but
We
that is what
do.
I'm interested in. Yeah.
Yeah, we do a lot of loans all over. We're in 40 states currently, and one of the things that surprised us is when rates went up, is our average loan size has gone down. We're doing
Hmm.
fewer big portfolio groupings. So 3 years ago, our average loan size was 275,000. Last year, it dropped to 190, and I think this year it's going to barely be 180.
Oh,
So,
wow.
so again, because we're in that second tier market, our average size has come down a little bit. So we just got to do more loans.
Yeah. Well, if you um, get loans on the higher end of that perspective, we just raised our caps on loan amounts last month, so we can go up to 2.5 million in certain places. So that's up from 1 million. So we wanted to see higher loan amounts, right? And you started to see that towards the end of the year, and a lot of that is on the new builds, the new build side, the new construction side, which is an area we really want to continue to be aggressive at. Feel like we have a very strong offer with the deferred interest on new builds, and can do that in all of our geos, and even some second home markets make a lot of sense right now for new construction. And it's as sort of this demographic shifts where people are more and more into retirement, the second home market is very interesting, and building there, both from an Airbnb perspective and from having a second residence or moving, builders setting up markets for people to move into. The migration patterns have been interesting. Not to skip too broadly, but have you seen your deal flow match that? Like, in other words, the Sun Belt, post COVID was experiencing a lot of migration that has cooled. Does your business flow that way? Can you see the migration patterns in how deals come in?
Yeah, I would say that a couple of years ago we did a lot of deals in Texas. We did a lot of deals in Florida.
Hmm.
I would say those numbers have. I mean, we're still doing quite a few there, but I'm seeing more in the Carolinas. I'm seeing more, like you said, in Alabama and in Georgia, um, and I would say fewer in the Florida market. We are not licensed in Arizona or Nevada, so I can't speak to that.
Hmm.
But I've heard that the Phoenix area has tempered quite a bit. I don't know about Las Vegas.
Yeah, I we as well in Arizona, we have relationships there that we can lend with, but we're not licensed there either. Definitely see a lot of loans out of like the Mountain West. Some interesting spots there, but we definitely saw, it was just very interesting to watch. You read the headlines about the migration patterns, and you look at your loan volume, and it's very telling, right? Just think that's an interesting thing to observe. So we're getting sort of close here on time, but I wanted to say, if you had one prediction to make, and I have one about 25, sort of this is the gotcha question, Damon. So you knew it was
All
coming.
right.
What is the prediction that you have for 2025 that either would be expected or not?
Well, I think that 25 will likely be, in my mind, a lot like 24. We're forecasting another 50% increase in our volume, so we think things are going to be good. But we know our team can hit that goal, even with a little bit of hardship thrown at them. So we think it's going to be a good year for this particular business. As you mentioned, this is still kind of in its infancy. The
Mhm.
SCR is brand new. The RTL, or the short-term loans, are just now being recognized for institutional securitization. So the capital flow into these particular products, until they can find something better, I think will continue to flow into these asset classes. I mean, where else can you get, 10 or 12% return on a real estate secured asset? I don't know.
First lien, right? Yep. Our investors see that and are coming to the platform consistently. It's something that I've been proud of over the course of time, is the consistency of capital that we've had and continue to have. And now with, the securitization element of our origination platform, even more so, right? And so I think, my prediction, and I've alluded to it a little bit, is just, being more aggressive in the Northeast and the Midwest. We have a Sunbelt portfolio right now that makes up the majority of our loans. And so even though we do lend in 31 states, I would say that, we're going to have a greater impact on some markets that we've, not prioritized on in the past. So I look forward to that, expanding into new markets, both on the investor side and on the lending side. And we hope you're going to be there to, feed us deals to help do that. And we look forward to that as well.
We will work to do that.
Yeah, well, we really appreciate your partnership here at Groundfloor. I read the competitive survey that you guys do at loanbids.com. It's a must read. It comes out quarterly, and it's a very good spreadsheet and one sheet comparison of what everyone's doing. And you can get specific guideline information and pricing across definitely the RTL space. So I really do love that product. It's very good. I'm glad that you do that. It's been very
Thank you for the pitch. Yeah, we've been doing that for 7 years. So again, you guys have been one of the long subscribers to that publication, and it's not a money-making proposition for us. It's really just to help us, be in tune and help our lender partners get better, because when they get better, we get better programs and pricing. So
absolutely. Well, appreciate your time today and look forward to a very prosperous 2025, Damon.
You as well.
Thank you.